to the Short Vol Show. It is a Monday morning and markets are down, and the news is tariff escalation once again, coming from first United States and then China countering the tariffs. This happened actually, I think it happened on Friday, but markets once again going down based on this. And you would think, okay, wow, markets down, VIX up, UVXY must be screaming, TVIX must be exploding, everybody must be making their money back who got long these things. Well, sort of. Coming into expiration now, so the spread between spot and M1 is basically collapsing, is collapsed. There's pretty much no spread. There's no space between spot and M1 right now. Well, but actually there's like 10 cents. And, UVXY kind of underperforming here, indicated up about 40 cents. TVIX, remember TVIX split a couple days ago, so TVIX up a couple bucks from 39.85 where it closed, indicated now 41.72 bid at 41.75, so up a little bit. But once again, sort of underperforming. The futures are off the lows a little bit now. Let's take a look where we stand. And to do that, I have to get rid of my little view of South Beach there. Somebody asked me that, yes, that is a friend of mine's place at South Beach. Let's see if I can just sort of widen this out a little bit here. Yeah, so basically, that's the wrong view. Let's take a look at E-minis once again here. And sorry, my stuff is disorganized here. Overnight, we see... and here we go. A little bit off the lows. I'm in the way of it, of course. Let me move out of the way here. All right, so and move that up. There we go. Stuff a little bit off the lows, as you can see here. And really, once again, UVXY kind of underperforming things here. A lot of articles over the weekend. Seth just pointed me to one on his site about kind of refuting some of the articles over the weekend, but I saw too that there are a lot of articles saying either is vol too low, has vol reached a bottom, et cetera, et cetera. Plus an article talking about the trader 50 Cent coming in. All of it sort of pointing to, it seems like the newspapers and stuff are trying to tell retail to get long vol here, is basically what it comes down to me. And I think that the basis for all of that is they're just looking at the VIX and saying the VIX is lower than it was a while ago. And but meanwhile, the we're still massively in we're in contango. Stuff is just going to decay from here. And I don't see any compelling reason to get long vol right here. Let's take a look at the term structure here. And I'm going to look at a specific function of this on VIX Central. If we go to this contango little button, and I know this is kind of distracting, so let's try one more time to get rid of, let's try to widen this thing out a little bit here, and then once again move myself out of the way. All right, so if you look at this chart here, this is contango over time, and the end part here is what we're looking at, 2018, and the light blue line is contango, which is affecting us. Basically, that's between the first and second month futures. And you see it going way negative here, and that's when we were in backwardation. But then you see it back positive. Anything above this red line means that these products are in decay. And you see that they're almost always in decay, and you can see us building how much decay we're in over the last couple months, okay? That shows us going more into decay. It doesn't show us sort of like now's the time to get long VIX ETPs. So I think that this is part of the press not understanding our products. It's also part of the press just looking for something to say about the VIX. And so they look at the chart and they say, oh, VIX is down. Well, why don't we look at the chart together for a second? You know, my point here is that volatility trading is a lot more than just looking at the VIX. A, and B, even if we look at the VIX, it's not clear. So let's look at the VIX now. Okay, so here is, I'm going to go to the 1 year chart of the VIX here, okay? And I'm going to move it around again so that we can get this straightened out. Okay, so you can see where we are on the chart here, and it's not clear that this is a buying point. You can see the low here that was most of the year is significantly lower than where we are now. Is it a buy here? Well, it could leak down to where it was before easily. I mean, we're in a downtrend, and it could keep leaking down to where we are. There's no reason to try to catch the falling knife here and say, okay, well, that's the bottom. Now, historically, you could say, like, if I back the chart up to 3 years, it becomes a bit more confusing, of course. Here's the 3 year chart, and you can see, once again, we're kind of, if you look at the average over 3 years, we're kind of slightly in the low end of the range here for 3 years. But even on the 3 year chart, you can see we're kind of trending down since that big spike, and it's just not clear. It's not clear that this is an inflection point. If we were down at 8, I would say, oh yeah, or not even 8, like 9, I would say, oh yeah, we're at the bottom. But we're not. We're in a downtrend, and it's not clear that this downtrend is going to stop right now. Another thing I wanted to mention is that this today's show is brought to you by Gorilla Trades. So please check out Gorilla Trades, link in the description, and their stock signals. I want to go into them a little bit more coming up in the next couple of shows and talk about how they actually set up their recommendations and the whole triggering mechanism and how it all works, because it's pretty interesting, and they have a great track record and proven results. So while we're still on volatility here, I want to talk about another thing that has to do with the term structure, and that is the long end of the curve. So the far out options, the far out futures that are months and months out, there's been debate over where they quote unquote should be, and that they should be higher, and that the curve should be steeper, and all this stuff. And this kind of the case being made is that, well, the average of volatility over X amount of years is like 18, and the highest futures are only 16 and change, and that's too low because it's below the average. The point I often make with people when they come in with these cases like this is that the far out months don't trade very much, and it's sort of based on supply and demand, and there's really not a whole lot of volume going on in those months, and so it's not very significant information what price they're trading at, in my opinion. The farther out stuff, the front month stuff trades heavily, but the farther out stuff hardly trades. And we're early in the day right now, but if you look at barchart.com here, for example, just to give you some indication, you can see the first 2 months, June and July, 7,800 contracts, 8,200 contracts. The third month, 4,000 contracts. But when you get out to the farthest months, Jan 19, 20 contracts, 14 contracts. December, 131 contracts. So when you have such a small volume trading, this is very insignificant, because if somebody did come in with a big order, it would move the market on these things. The forces of supply and demand on this far out stuff are not as clear as they are for the more liquid series. They're also more susceptible to manipulation, and so I don't place a whole lot of meaning in this farther out futures in the term structure. Quote unquote, should they be higher? Well, that's when you're in the market and stuff is trading a certain place. The logical thing is that's the market. That's where they are. And saying it should be higher. Well, the reality is it isn't. In February when we had the spike and we came down off of that spike, some of the farther out futures actually moved higher before moving lower. The farthest ones out, like I believe ACH and DEES, were up to 18, and they actually did move up to 19 and 20s before moving lower again. So this stuff moves around. I wouldn't like read too much into where it is at any one time, because once again, very illiquid, not much going on those series, and not that meaningful. And meanwhile, there's been a lot of talk in the Facebook group about both what kind of brokerage, which brokerage you should use, and also some talk about how to hedge a short position, a short stock position in TVIX. And I put my 2 cents in, but I just want to kind of add a disclaimer here in that I'm principally an options trader. There are many people that have a sort of a core short position where they have a certain short amount of stock, and the question is how to hedge that. And like I said, I put my 2 cents in, but I'm not necessarily the best person to answer that because I mostly trade options. I don't incur the same risk as somebody who shorts TVIX. If I buy some puts, I can lose the value of the puts, but I don't keep making more and more losses as things go up. In fact, as stuff goes away from the strike that I'm long, the losses as it goes higher and higher are smaller and smaller because I can only lose down to what the puts are worth. So, for example, I bought December puts in UVXY for $2 and change. Even if UVXY spikes upward, way upward, those puts are going to still have some value because there's a good chance that UVXY goes back down before they expire. And so I had suggested buying a different couple call spreads that you could use to hedge being short TVIX, and yeah, those do eat into your profitability. And I think that they're people who are doing these plays, you're not always going to be fully hedged because that takes away from your profitability. It comes down to me, it comes down to the fact that if you want to make money, you have to take risk. And so if you're fully hedged all the time, that's going to lower your returns, and you're not going to make very much because you're not taking a whole lot of that much risk. It's a risk reward thing. Yes, you want to optimize your risk reward, but if you're not taking risk, there's not going to be a reward. There's no perpetual motion machine that is going to print money for you all the time without you taking some sort of risk. That's just the way trading works. Nobody's just going to hand you free money. And that is the word today. Let's take a look quickly at investing.com. Basically, I know that they're just talking about China tariffs coming up. It says Wall Street poised for lower open on trade war concerns. A lot of commentary over the weekend about this children being torn from their parents at the border stuff, and I think that will continue. Yeah, these Bitcoin and stuff have really been getting hammered lately. Bitcoin down to below 7,000, now 6,400. The whole crypto just been getting pounded, it seems. Anyway, we're rolling a little bit lower now as we head towards the open, and we'll have to see what happens today. But once again, UVXY kind of underperforming, trading 1021 at 1023. We've had this tariff stuff before, and it's pretty much amounted to nothing. So we'll just have to see what it amounts to this time. And good luck trading today, and I will talk to you tomorrow.